Welcome to The Explainer. Today, we're going to follow a single automated crypto trade as it goes head-to-head with one of the market's wildest rides, a massive price storm.
So that question right there, it gets us into a really fascinating strategy. See, this isn't about betting if the price is going to go up or down. Nope. It's about betting on how much it moves. A totally different game. And this technique, it's called dynamic delta hedging, or DDH for short. Now, in plain English, what it does is use automated tools to basically cancel out the risk of which direction the price moves. That lets traders focus almost entirely on trading the movement itself, the volatility.
All right, so let's see how this actually plays out in the real world. We're going to dig into a case study of a pretty small automated trade that put this exact theory on trial. The goal? Super simple. Sell some options, collect that premium up front, and then make a bet that the market's actual, realized volatility ends up being lower than what the options market was pricing in.
So the trader we're following here, they're what's known as short volatility. And that just means they're on the side that profits if the price stays relatively calm, if it moves as little as possible. That way, their hedging costs stay low, and they get to pocket more of that sweet premium they collected right at the start.
Okay, so here's the million-dollar question. How do you actually build this thing? Well, it all kicks off with setting up a position that has zero initial directional bias. I'm talking about a position that, right out of the gate, literally does not care if the price goes up or down.
And the process we're looking at here breaks down into 3 key steps. First, you place the bet. You sell 2 opposing options to bet against any huge price swings. Second, you configure the tool, the software that's going to do all the hard work for you. And then third, you just go live. Flip that switch and let the robot take the wheel.
And this right here really shows you the heart of the idea. The trader sells a call option, which is basically a bet that the price won't shoot up too high. That gives them some negative directional risk, what we call delta. Then they also sell a put option, a bet the price won't crash too low, and that adds positive delta. So you've got these 2 opposing forces that right at the start almost perfectly balance each other out. Pretty neat, right?
Now let's get into the nitty-gritty of this specific trade. The trader sold a call at a strike price of $36,000 and a put down at $33,500. And if you look at their starting deltas, you can see how the positive and negative exposures were super close. This created a position that was almost perfectly balanced from the get-go, or delta neutral.
Okay, so the trap is set. Now the automated tool gets armed. The trader set it up to keep an eye on the position's delta, like 24/7. The rule was simple. If the position ever started to lean one way or the other by more than 0.01, the tool had one job: automatically jump in, make a trade, and pull it right back to neutral. No questions asked, no matter what.
So for 13 hours, nothing. Crickets. The system just sat there, waiting. And then, the market finally decided to wake up. What happened was Bitcoin's price started to fall. As it did, the value of that put option shifted, and the whole portfolio ended up with a positive delta, a tiny little bullish lean. But that lean was just enough to cross the line, that preset threshold, and bam, the system was triggered.
And just like that, the software sprang into action. It automatically sold a small chunk of Bitcoin futures to fight back against that positive delta. That was its very first hedge, and it brought the whole position right back into balance. And the best part? The trader didn't have to lift a finger.
Okay, but fast forward 2 days. The market didn't just move this time, it exploded. We're talking a massive price rally that created this sudden, incredibly high-stakes stress test for the whole automated strategy. This was the real test.
So Bitcoin's price just went on a tear, hard and fast. Within hours, it didn't just get close to the trade's boundary. It completely blew past the $36,000 strike price of that short call. And just like that, that part of the trade was deep in the danger zone.
As that call option plunged deeper and deeper into a loss, its negative delta just kept getting bigger. This is where the automation really had to earn its keep, working overtime. I love this quote from the trader in the source material. They said the tool was, thankfully, doing its job, constantly fighting back against that huge directional risk.
Now this is fascinating. Take a look at the robot's activity log here. You can see this absolute flurry of trades.
As the price was just screaming upwards, the tool was just relentlessly, methodically buying these small amounts of futures again and again to fight that growing negative delta. It was basically battling the position's own bet against this massive rally. Right in the middle of this chaos, the tool made over 15 separate, completely automatic adjustments. Think about that. Each one was a tiny, precise little course correction, all designed to keep the ship from sinking while the storm raged all around it. So a few hours go by, the price is still climbing, and the risk on that short call is just getting to be too much. So the trader decides it's time to step in. They manually put in an order to close out the most dangerous part of the trade, that bleeding short call. And check this out. The second that manual order gets filled, the whole portfolio's delta just flips on its head. And the tool, still watching, still ready. It instantly reacts to that change and executes a way bigger hedge, selling over $3,000 in futures to rebalance the leftover position one final time. All right, so after all that chaos, after all those little robot trades, after that insane price surge, the big question is, did it work? What was the final score?
Well, here's the final P&L. After you take the premium they collected and subtract all the costs and losses from hedging that crazy price move, the final result was a tiny net loss, about 0.0005 Bitcoin. So yeah, it was a loss. But, and this is a huge but, it was way, way smaller than the catastrophe that would have happened to an unhedged position in that same situation.
And this really hammers home a key point from the trader. They said it perfectly. Dynamic delta hedging is a really powerful tool for managing risk, but it's not some magic wand. It's not going to stop you from ever having a loss.
So let's just wrap this up. What did we see? Well, the strategy did what it was supposed to do. It traded volatility. The automation steered the ship through absolute chaos with dozens of tiny adjustments. And maybe the most important takeaway here is that it took a potentially catastrophic loss and turned it into a small, manageable one. Its job was to manage risk, and that's exactly what it did.
So this whole thing showed us how a robot can navigate a crazy storm. But it leaves us with a really interesting kind of reverse question for anyone playing this game. What happens when the biggest threat isn't a violent storm, but a dead, boring, flat-out calm?